Now it's going to get busy as the results season for year-end, interim or quarterly periods that finished in June starts to hit top gear. We're also about to get the latest central bank decisions on monetary policy for good measure. Top down, it's Europe that will dominate in the coming week because the latest European Central Bank policy meeting takes place on Thursday, the 25th of July. President Mario Draghi steps down in the autumn and his proposed successor, Christine Lagarde, formerly of the International Monetary Fund, is already championing her predecessor's zero and negative interest rate policies. But before she takes over, Senor Draghi is expected to start loosening policy once more, and this ECB meeting is his next chance to act. So, watch for, first, any move to cut the headline refinancing interest rate from 0. Second, any move to cut the deposit rate from minus 0.4%. So yes, banks have to pay to park their money with the ECB as part of a plan to get them to spend and lend more. Now, neither the refinancing or deposit rate have changed since March 2016, by the way. And third, look for any resumption of quantitative easing, barely 8 months after the ECB stopped adding to its 2.5 trillion plus euro corporate and bond buying programme. This chart shows all three tools over the past decade. It does slightly make you wonder whether more of the same policies that have failed to promote growth and get the ECB to its 2% inflation target for 10 years is a good idea or not. We shall see. But I think it's pretty fair to say that the markets will be stunned if Senor Draghi does nothing between now and his departure in the autumn. Company-wise, nearly a fifth of the FTSE 100's members are due to release a trading update, results, or host their annual general meeting in the week ahead. A good number of small and mid caps will be doing the same. Names which may be worthy of note would include Minor Petra Diamonds on Monday the 22nd of July, Fever Tree Drinks, Assos, Jules and PZ Cussons on the 23rd, Experian, Croda, Antofagasta and Metrobank on the 24th, Compass, Halma, Unilever, AstraZeneca, Diageo and Anglo American on a very busy Thursday the 25th, and finally Vodafone, United Utilities, Rightmove and Pearson on Friday the 26th of July. But for me, the stock most likely to cause a big fuss in the week ahead is GlaxoSmithKline. The pharmaceutical giant is due to release its first half results on Wednesday the 24th of July. As we can see here, the shares have put on a bit of a run in the past few months, even if that doesn't get them back to where they were in summer 2017. Whether this is due to investors warming to the major corporate overhaul launched by Chief Executive Emma Walmsley, or a wider reappraisal of the pharmaceuticals sector, which tends to do well during times of economic uncertainty or market strife, is hard to divine. But these interim results could help investors to find out which. In terms of strategy, GlaxoSmithKline has already announced 3 major deals since Emma Walmsley took the helm in April 2017. In March 2018, the company bought out the 36.5% stake held in a consumer healthcare joint venture by Switzerland's Novartis with a price tag of £9.2 billion. In December 2018, GlaxoSmithKline then acquired American cancer drug specialist Tesaro for £4 billion in a move designed to reinvigorate the group's pipeline and growth profile. And also last December, the firm then announced it would merge its now wholly owned consumer healthcare venture with the equivalent business at America's Pfizer. This deal is still awaiting clearance from regulators, but within 3 years of closure of the deal, it's GlaxoSmithKline's plan to demerge its 68% stake in that new business and float it on the London Stock Exchange. That would leave GlaxoSmithKline focused on just pharmaceuticals and vaccines, and a much simpler company than the one Emma Walmsley inherited. Now, one feature of the results will therefore be any comment from the company on the regulatory process associated with that Pfizer deal. Another will be any commentary from Emma Walmsley and her team on GlaxoSmithKline's drug development and trial pipeline, as well as sales of recently launched products such as shingles treatment Shingrich, as well as its HIV drugs. Now, in terms of the numbers, analysts will home in on 3 particular figures. The first is sales, as this will indicate how GlaxoSmithKline's new drugs are helping to compensate for the loss of patent protection on older ones, which opens them up to generic competition. In the first quarter, sales rose 5% year on year, and the base for comparison for the first half of last year is £14.5 billion. The second number analysts will be watching is earnings per share. GlaxoSmithKline has forecast that earnings per share, or EPS, will drop by some 5 to 9% on a like-for-like basis in 2019. Note that the company is one of those that prefers to look at adjusted earnings per share, and the gap between the stated and adjusted figures has been, well, pretty wide for some time. Make of that what you will. Finally, analysts and investors will look at the dividend. The company has already said it will pay an unchanged figure of 80 pence a share for the full year, so that should mean 38 pence for the first half against the same figure a year ago. After that, GlaxoSmithKline has made no commitments, with investment in research a priority and shareholder returns high up its list of capital allocation options. As we can see in this final graphic, GlaxoSmithKline has not increased its dividend since 2014, and earnings cover for the dividend is lower than ideal at around 1.4 times, according to analyst consensus forecasts. So investors need to think about that when they do their research and weigh up whether the 5% dividend yield is sufficient compensation for the risks involved. Thank you for watching, and I look forward to seeing you next time.